are alarming and nobody wants to see them. But as an investment strategist, how do you take the data and offset it with all the support that's coming from the government right now? Because there's a lot of people looking at stocks puzzling over how there can be such optimism during this period.
Well, hey, Oliver. Good morning. I think something to think about when you're looking at the jobless claims number is as we're looking at everything and we're seeing how unprecedented these numbers are, is it's really just a starting point. We're looking at tomorrow's payroll number, and I'm forecasting anywhere between 15 million and 25 million jobs lost. At that point, we're really talking about something that we don't have any context in terms of how we decipher what does that look like. I mean, previous recessions don't give us any kind of context there. So I really think what we're doing now is we're writing the first chapter in the new employment market look. We did have a very tight labor market going into the crisis here, and so we'll get a chance to kind of see. This is our first chapter we're writing tomorrow in terms of the employment. We'll get a chance to see different segments of the book as we go along. Every week, getting our continuing claims numbers and seeing if those start to trend lower. And as we move into the summer, that's when we're really going to want to look at those non-farm payroll numbers to get a sense of, are they coming down? Are workers going back to work? Are companies rehiring employees like we expect them to? And that's going to really tell us whether or not the recovery is going to be gradual, slow, quick, and give us a sense for the pace of any kind of recovery coming.
Patrick, right now, the question of how many jobs return once the economy starts to reopen is a big part of this. The other one is whether or not there's still these kind of aftershocks coming from bankruptcies that are still being filed and overall just blowback from some of the big market moves. Do you think that we have gotten past the worst? I mean, is there a possibility where we're going to see the moving average for these jobless claims tick back up? Because right now, it looks like it's started to roll over. Should we expect that to continue to roll over?
Well, Oliver, I think the Fed has done a really good job of preventing what you said, the worst of it, at least for the time being, as well as the government with their massive amounts of stimulus and possibly more stimulus borrowing for an infrastructure plan coming as well. So I think the amount of liquidity that's been thrown into the marketplace, both by the Federal Reserve and the amount of stimulus by the government, has done a good job to stem what you would call the worst of it. I think at this point, as we come out of things later in 2020, it's going to be really about sorting out the winners and the losers, because in the end, there will be some damage that's done to the economy that might be more permanent. And we don't really know net yet. We can speculate on who those winners and losers are, but we just don't know yet who they might be and what things might look like, because there is so much uncertainty right now.
Yeah. So with the backstop from the Fed, we've gotten an interesting result this time, Patrick. In 2019, after the Fed signaled it was going to do its cuts and it reversed course, you could buy just about anything. And you were up, and you were up pretty big. You bought bonds, good. Stocks, good. Bitcoin, gold, anything. And everything was climbing. This time around, it looks like it's basically limited to stocks. Treasuries haven't moved in 2 months. Gold hasn't moved in a month. What's going on here?
Well, I think that part of it is as we're getting closer to the zero bound in terms of interest rates, right? There's a huge debate on whether or not rates in the United States can go to negative territory, and that debate continues. And I think as we're close, I mean, the 2-year note is at 17 basis points, the 10-year note is at 68 basis points. So as we approach the zero bound, there's just less room for upside, especially in government bonds. As we're talking about corporate bonds, there still seems to be some room there. If you're picking through corporate bonds, you talk a little bit about corporate bond issuance right now. This week alone, we've already had $63.5 billion, which puts us on pace for about $830 billion, which is just about double the run rate of last year at this point. So we're seeing still opportunities for investors in corporate bonds and in other fixed income products that maybe aren't government bond specific.
As the Fed begins to actually buy high yield, what is that going to mean for this market? We know that there's been this kind of placebo effect, as they said they were going to buy, and then they didn't. And now they're saying that, well, we're going to start buying. Should that change the dynamic for high yield?
Well, it certainly opens the door for certain issuers. If you remember, the high yield bonds that are going to be bought would be the fallen angels, some of your companies that were investment grade prior, at least on one side, investment grade prior to the middle of March there. So some of the bonds that you're buying are going to be your highest level of junk, as well as potentially buying some of those, having exposure, to some of those other credits when we're talking about buying ETFs. They haven't bought one single investment-grade bond or one single high-yield bond yet. Yet the effect has been very much to cause spreads to go tighter. We've seen spreads in IG go tighter. We've also seen bid-ask spreads in the market, shrinking quite a bit. I mean, I think middle of March we saw bid-ask spreads in 18.5 to 20 basis points, and now we've shrunk down to almost 5 basis points in terms of bid-ask. So that's showing you that the liquidity in the corporate markets has improved significantly, and that's with record issuance. So that shows you that the Fed's willingness to buy, and they said they would buy 750 billion is the price tag on these programs. However, we've noticed that with the Treasury, similar to the Treasury buying program, where they said, well, we're going to buy X amount, and then they came out in March and said, well, we'll buy infinity, whatever it takes to restore order and to bring balance to the markets and restore liquidity. We'll do that. And I think there's a little bit of that going on in the corporate market, that the Fed will be willing to do whatever it takes to keep the markets functioning and to keep the economy moving, at this point.
So, Patrick, if the Fed has been doing all that you described, which we know that they said $3 trillion is their plan to borrow right now, what then should we make of, again, to come to the Treasury market kind of as our baseline, that with that Fed buyer more present than ever, that we still have flatlined on Treasuries right now? Does that mean as they unwind and start to dial back on their buying, that we should expect more downside to prices, upside to yield?
Well, I think at this point, we saw yesterday when the Treasury did announce their quarterly refunding, and we saw that their needs for longer maturity buckets. They introduced a new 20-year bond to the mix. And they also increased the sizes that they're going to auction in both the 10, 20, and 30-year maturity buckets. And we saw a slight reaction from the market where we saw longer-dated Treasuries selling off and shorter-dated Treasuries more stable or rallying. And so we did see a steepener in the yield curve yesterday as a result of that announcement. And I think that a lot of that is we're trying to figure out, as the Fed has attempted to back away from buying so many Treasuries in the marketplace, the investors, we have to find out who the other investors are that are going to be participating in these longer-dated auctions and what the balance is there. I think the reason you're not seeing Treasuries sell off more significantly is that everyone believes that if rates do start to climb too much, the Fed's going to step in, and the Fed is going to make something happen there, and they're going to support markets. So we have kind of this tug-of-war or balancing act, if you will, that's happening between the Treasury's massive amounts of issuance that need to be done, but the Federal Reserve's massive balance sheet to support it. And that's why I think you're seeing Treasuries come into a more narrow range here and really, as you said, flatline in terms of where they're at right now.